Welcome to Investing Insights. I'm your host, Ivana Hampton. Leverage can magnify a portfolio's performance for better or worse. Poor results have sunk many leveraged ETFs. So, how can an investor use leverage to optimize their investments instead of destroying them? Bryan Armour is the Director of Passive Strategies Research for North America for Morningstar Research Services. He's also the editor of Morningstar's ETF Investor newsletter. We talked about a better way to use leverage. Great to see you, Bryan.
Yeah, thanks for having me.
Let's start today with what is leverage and why does it have a debatable reputation?
Yeah, leverage basically is borrowing money to invest. And so obviously that ends up magnifying returns um, because you're using less money to gain more exposure, which is effectively what leverage is. And leverage comes at a cost. And so obviously when you're borrowing from someone, they want to make money lending it to you. They also want to make sure that they don't lose their money. And so there's risks on their side as well as yours. And so when one of the issues is when markets sour, then they're more likely to want their money back. And so that can end up having a compounding effect as your investment's losing money, and it also becomes more expensive to employ leverage. And so that's why leverage traditionally has been at the center of a lot of different market downturns. So whether it be unregulated margin accounts during the Great Depression or Lehman Brothers highly leveraged balance sheet in 2007. And so there have been many times where leverage has been at the center of these market crashes. But likewise, we also use leverage in our daily lives. We have mortgages, we have credit card bills. And so it's a strange dichotomy. Warren Buffett uses leverage in Berkshire Hathaway. So it's all sorts of different sides to leverage, but obviously it has a bad reputation for its role in market crashes.
Would you say another reason for its reputation is because of the so-called volatility drag and how some leverage ETFs reset their exposure?
Yeah. So in the ETF world, leveraged ETFs often or traditionally were like 2 times S&P 500 ETF or any type of strategy or asset under the sun at this point. But what they do to achieve daily leverage is they reset swaps every day. So it goes up, they need to add more exposure. If it goes down, they take exposure off. And so what happens is in choppy markets when the underlying assets going up and down is you're buying high and you're selling low on repeat as they're adjusting the exposure. And so that ends up having a significant drag on performance and one that's killed a lot of different leverage ETFs over time.
And you say leverage kills ETFs. We were just talking about this off camera. When has that been the case and what do the returns look like, Bryan?
So it happens quite often, unfortunately. Nearly half of U.S. leverage ETFs and exchange trade notes, so together ETPs, have closed, and 13% of all leverage ETPs have returned negative 98% or worse since inception. So there's obviously a long track record of this behavior and where volatility decay over time really destroys a performance. And that's why they're required by regulators to say daily 2 times leverage because they're not intended to be held longer than a single day.
Gotcha. And when you say ETPs, you mean what?
Exchange trade funds and exchange trade notes together. Yeah.
Awesome. So, in the September edition of the ETF Investor newsletter, you wrote that there's a better way to use leverage, and it would require creating an optimal portfolio that aligns with an investor's stomach for risk. Can you give us an example?
Yeah. So the classic academic example, it's called the efficient frontiers. You take various different types of portfolios and you sort of plot them based on the risk and return, and then you look at which one has the highest return for the amount of risk it takes. So if you think of like you have 3 portfolios, one has 0% in stocks, 100% bonds. You have a 50-50, and then you have 100% stocks, 0% bonds. The 100% stock portfolio is going to have the highest return, but also takes the most risk. And so if you're willing to take that much risk, then what you should look for is the highest return as a unit of risk, and then lever that up to the return of the 100% stock portfolio. And so what that does is it looks at Sharpe ratio, which we talk about a lot, which is risk adjusted performance or returns. And you can use leverage to reach that same level of risk, but receive a higher total return at the end of the day.
And what are some ways an investor can add leverage to their portfolio minus that volatility drag?
Yeah, volatility drag can still make its way in no matter what. But um, the classic way is margin. So if you think personal, a brokerage account, you can add margin that allows you to borrow money. You can then invest. And so that's one way to get leverage. And then derivatives are another popular option. So think options. You like each stock option you buy gives you the right, if it's a call option, to buy 100 shares of the underlying stock. So that provides leverage in that way. And then futures, swaps are also other derivatives that provide leverage. And then you can also do leverage ETFs. So not always just the 2 times whatever, but daily reset. But there are ETFs that employ leverage in different ways.
Well, I'm going to bring up something that comes up every time you're here. Costs, because they matter too. Which one of those choices you just named would give investors the most bang for their buck?
Yeah. So margin accounts, if you're an investor with a brokerage account at Fidelity or E-Trade or Vanguard or Schwab, you could be paying 12% to borrow those funds. And so that is not an efficient way to gain leverage. 12% is going to be a high bar that's difficult for investors to consistently beat on their investments to out earn that leverage, cost of leverage. So options might be a little bit better, but there's a complicated return profile with options. If you look at something like futures, that's going to be the most efficient. It's highly liquid underlying market. And then there's also, there's institutional borrowing costs embedded in the futures price. So it's going to be more like right now, like 5.5% versus 12%, which is obviously significantly different. So futures are more efficient, and so swaps are really just out of retail investors' reach, other than through ETFs.
So, what type of investor should consider using leverage? I mean, are you a DIYer or am I going to my financial advisor?
Well, DIYers should be very careful operating leverage on their own, just because these costs aren't always obvious, and also you can be stuck when I talk about the compounding impact of leverage when markets go down. You could get a margin call when you weren't expecting it. There are just potential issues, and maintaining the correct leverage and managing that can be very difficult. So DIYers, it's going to be tough. Financial advisors, they don't spend a ton of time trying to figure that out either. And so I don't know that would be that much better. It really comes down to, for most retail investors, an ETF or leverage through a mutual fund would probably be the best way of gaining exposure.
Bryan, what leverage ETFs have shown promise in Morningstar's opinion?
Yeah, so we've dug into a couple different series that have shown more promise than your typical daily reset 2 times leveraged ETF. And those would be the Wisdom Tree Core Efficient funds, and then also the newer return stacked ETFs, which are for Wisdom Tree, they'll use futures to gain additional increment of exposure. Think about like a 60-40, providing exposure up to 90-60. And then for return stack, they look to add 2 times exposure for a single dollar. And so regardless of whichever assets you choose within that mix, you get a little bit more exposure by the use of futures, which, as we said, was the most optimal way to use leverage.
Well, Bryan, thank you for coming to the table and explaining how we can use leverage to optimize our portfolio instead of destroying it.
Yeah, absolutely. Anytime.
Here's the markets in brief for the week ahead. Wall Street will debate the Federal Reserve's next interest rate move. The Fed is scheduled to start its two-day meeting on Wednesday, November 6th. They're expected to announce their interest rate decision on Thursday. They cut rates by a half a percentage point in September as they shifted their focus from inflation to the job market. Now, big tech is turning to nuclear energy to power the AI boom. Microsoft, Amazon, and Google are partnering with utilities and others to quench data centers' nonstop thirst. But could the tech companies' investments revive a broader interest in nuclear energy? And which utility could sign a deal next? Travis Miller is a strategist for Morningstar Research Services and covers energy companies. We talked about the growing demand for carbon-free energy. Welcome back to the podcast, Travis.
Thanks for having me.
Now, we've talked before on the podcast about the electricity needs for the AI expansion. I want you to help us picture how much energy a data center needs to run 24/7. What is that equivalent to in our everyday lives?
Yeah, I mean, some of these numbers are just incredible that we're seeing. And it's kind of fun as a utilities analyst here because we've never had electricity demand projected growth or growth opportunities like this in a long, long, long time, even back to the Industrial Revolution. I mean, some of these numbers that utilities are throwing out on data centers is incredible. So probably the best bring it home literally is a typical home uses kind of 10 kilowatts. So when you've got all the stuff running in middle of the day, maybe even in early afternoon, 10 kilowatts, some of these data centers, the large ones, are going to do 150,000 kilowatts at their peak.
Wow.
You look even more expanding that, a large data center right now in Virginia uses about 50 times the electricity as a equivalent square foot of office building space. So for every square foot of data center, using 50 times the electricity of a square foot of a office building, regular office building. In Northwest Indiana, so Microsoft has a deal and proposed plant or data center there. The utility in Northwest Indiana has said 2 to 3 data centers of these hyperscale type level data centers will double electricity demands in Northwest Indiana. 8 data centers, which they're negotiating in probably 2035, so we're still talking, decade and a half out, would quadruple electricity demands in Northwest Indiana. So you can start extrapolating these and, with all of the discussion about how many data centers might go up, how many data centers are going to be needed for AI and all these other digitalization applications, the electricity numbers get really, really, really big, really fast.
For sure. Well, Amazon and Google have recently signed nuclear deals with providers. The focus is on small modular reactors, also known as SMRs.
Yeah.
Talk about what's significant about this next generation technology and when these reactors could come online.
Yeah, so given what we just talked about in terms of the amount of electricity need to bring just a single data center online, wind and solar are not going to get it done. And really, that's all any utilities are building right now. And frankly, that's all the governments, either state or federal, will allow utilities to build for the various environmental reasons. Wind and solar, not only are they too small, they only run when the sun shines and the wind blows. So that's not when data centers want to run. Data centers want to run 24/7, and the wind and the sun don't shine 24/7. So utilities and data centers, operators, the developers, Microsoft, Amazon, Google, they're trying to find some way to get all of the electrons that they need to run these data centers. The options right now really are natural gas and something else. That's the big something else. And small modular reactors are part of that something else. Now, SMRs have been around for a long, long time. The technology has been around for a long, long time. Utilities have studied using them in certain applications for a long, long time. Utilities have never had the amount of demand and challenges serving that demand as they might in the next decade with data centers. So utilities are looking at any solution, and SMRs are a technology that's been around and could be a solution, although they're very, very, very expensive.
So let's see. It's 2024, so 2034.
That's the big challenge, right? We got a real pull here. This dynamic between the data center developers and all the tech companies who want their data centers online right now.
Yeah.
They want all their electrons right now. They want to start producing all these big models, et cetera. And the utility saying, well, I don't know, this might take us 4 or 5 years to build a power plant, to build an SMR. SMR is not only do you have to develop the technology, get really a private investor. Utilities are not going to do, and have said for many years, they're not going to do SMRs. There's too much risk around it. So you'll need a developer. You need a technology provider in terms of SMR technology provider. And then they have to work with the utilities to actually integrate them with the grid to serve the data centers. Put all that together, nothing happens quickly in utilities. And you're absolutely right that we could be talking 5+ years before a single SMR were to come online at the fastest.
Definitely some wait and see. Well, these companies have pledged to become carbon free at some point. Do you think that's the reason that's driving them towards nuclear energy?
Yeah, well, and that gets back to the idea of what are you going to choose to produce electrons, right? So you've got, again, solar, you've got wind. Those don't really serve data center needs. So carbon free, yes, is great. Data centers can't use that for their electrons. Natural gas has carbon emissions, low carbon emissions, but still carbon emissions. So that's not going to solve the carbon free piece of the puzzle. Nuclear, carbon free, whether that's large utility scale nuclear or the SMRs, again, it's the only thing left in the toolbox for utilities to provide electrons to data centers. And that's what data centers want, is carbon-free electrons. So solar and wind aren't going to get it done. Nuclear, either large scale or small scale, is going to have to be a solution if those data centers want to continue being carbon-free.
And which utilities are waiting on the sideline? I mean, who could sign a deal next?
Just about every utility, yes, has some kind of data center, and then they pitch, except for certain areas of the country where electricity is already really expensive. Again, I don't think we'll see utilities directly investing in either SMRs. I don't think we'll see them investing directly in large-scale new nuclear. Natural gas seems to be the preferred generation, incremental source of generation, solar, winds. But that's not going to get it done. So we really are, I think all the analysts are kind of searching for who's going to be the next utility to solve this problem, essentially. All these utilities have some substantial electricity demand needs over 5-10 years. Southern Company in Georgia, talking about 7 gigawatts, and to give you a sense, the largest nuclear plant, they just added half and is now 4 gigawatts. Largest nuclear plant in the U.S., just over 4 gigawatts, and they had just doubled that, Southern Company. And they have 25 gigawatts of potential pipeline data center demand. SMRs can't come close to that. SMRs are less than a gigawatt. So you need a lot of SMRs, a lot of gas, a lot of solar, a lot of winds to make any of these data centers viable. Big challenge there.
Are we witnessing a seismic shift when it comes to nuclear energy, or is this really tailored to data center demand?
I think this is really tailored to data center demands. We think that core demand, electricity demand growth, is only going to be about 1%. The other wild card here to think about is EVs. And the data center thing has kind of pushed EVs to the side, and we've seen some slack sales on EVs, so that's kind of out of the headlines. But in our calculations, EVs could actually ultimately in the next decade or more be more of an electricity demand issue than data centers. So data centers, massive numbers out there. There are issues, like we discussed, there are issues with actually getting electrons to the data centers. There aren't those issues with getting electrons to EVs. For most people who are charging at home, most people charging maybe in parking lots, shopping malls, the electrons are already flowing there. You don't need a lot of incremental generation, new generation in very specific places to serve EVs. We think EV demand, electricity demand, could quadruple just in a pretty normal environment, continued sales over the next decade plus. Now, EVs are a very, very, very small part of total electricity demand. Right now, less than 1%. If they quadruple, they still only get to 3 or 4%. But that's what happens to data centers. Data centers only get to 4% or so of total electricity demand in a decade. So there's this real fight between who's going to be the demand driver over the next decade for electricity. Is it data centers or is it EVs? I don't know that both can survive. I don't know that utilities can serve both, but it is important to recognize the differences there.
Well, you're going to have to watch. You got to tell us what the results are going to be on that. So we're taping this conversation right now, Wednesday, October 30th, and a handful of energy companies are going to report. Dominion, Duke. Talk about what you want to hear from these management teams in early November.
Yeah, I mean, I think it goes directly to what we were talking about is how are you going to serve electricity demand growth? Dominion serves what we call data center alley. It's the largest concentration of data centers in the world right now in Northern Virginia. So they have the experience in terms of serving these large load customers. That said, there's not a whole lot of incremental land, incremental infrastructure where we're going to see the hyper growth on data centers in Northern Virginia. But it is going to be interesting to hear from Dominion over the next several quarters about how they serve demands for data centers, how they might be able to help other utilities serve that demand. Can they continue serving demand as these data centers want more clean energy? So Dominion right now is building one of the largest offshore wind projects in the world, in part because their data center customers want clean energy. They're also one of the largest solar developers. You see a lot of wind and solar coming into the Virginia and that surrounding area. It's becoming very expensive, as we've seen from some of the price signals here in the last several months. So watch Dominion. Duke is one of those. If you put Duke and Southern, NiSource, several of these Midwest, Mid-Atlantic utilities, I think that's where you're going to see some of this new data center growth. So we're going to hear from them about how they plan to serve brand new large load.
And what energy companies does Morningstar consider undervalued at this time?
Yeah, no surprise. We do think there are several really good values where data centers are coming in. I mean, again, electricity demand growth solves a lot of problems for utilities. It creates earnings growth. It creates dividend growth. It could improve regulatory relationships. It could lower customer bills, depending on how the calculations go. A lot of things are still unknown, though. There's a lot of discussion about how do you charge data centers. If utilities go out and spend billions of dollars to hook up a data center, who pays for that? Does the customer at home pay for that? Does another business pay for that? Or should the data center pay for it itself? So there's still a lot of that going on. I think if you look at 4 names, we're talking about NiSource in Northwest Indiana. So I mentioned that. A lot of growth there. We think they could get up to even 8% earnings and dividend growth for a decade. They just extended their growth outlook and more potentially is coming. Duke Energy is one. Also, a lot of growth there from just core electricity demand growth as well as data center opportunity. WEC Energy, so up in Wisconsin, again, another data center story. Southeast Wisconsin is becoming a data center hub here. Microsoft also getting into data centers in that area of the country. And then Evergy is an interesting name that we haven't talked about a lot, but based in Kansas and Missouri, go figure, they also have a data center that could be coming in to that area. And they're seeing surprisingly strong core commercial, industrial, and residential growth there. If they can improve the regulatory environment in Missouri and Kansas, there's a lot of growth upside in terms of earnings and dividends.
Well, Travis, thank you for coming to the table today and explaining the latest on data centers and energy demands for them.
Sure. Thanks for having me.
That wraps up this week's episode. Thanks for watching and making this show part of your day. Subscribe to Morningstar's YouTube channel to see new videos about investment ideas, market trends, and analyst insights. Thanks to senior video producer Jake Vankerson and associate multimedia editor Jessica Bevel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.